I'm Eddie Cannell.
And I'm Tom Cannell.
Welcome, everyone. It is the Mortgage Brothers Show interest rate update for June 2nd, Thursday. It's a short week.
Short week.
Forgetting what day it is, but
Feels like Wednesday. No, it's a Friday. No, it's Thursday.
Thursday. And if you're new to the channel, be sure to subscribe, comment, and like. We're here for you, and we're going to, just before we get going, this is for informational purposes only.
That's right. We're smart, but we're not rocket scientists, folks.
That's right. No financial advice here. But we are going to show you the 30-year fix today is at 4.92%. A little bit higher than yesterday. It's really the only thing that really moved. The 15-year fix is still at 4.125.
Yep, the 5-year ARM, same as yesterday, 4.49. The 30-year FHA, 4.25. And the 30-year VA, 4.25. Boy, it feels good to be like a weather person. Like go in there and like calling out the states.
Quote. Okay, these quotes have no points. All right. If you're looking at if you're looking or shopping for rates, you're looking at anything else, points. These interest rates right here are based off of these scenarios for conventional FHA and VA, and they come with no points, no extra fees.
No points, right. What you're interested in is what is my interest rate, what is the origination fee, and are there points? So what we're talking about is the points. There are no points here. Every lender has an origination fee. If they don't, it's built into the rate. So that's an important thing. There is an origination fee. Every lender's have them. They got to keep the lights on, but there is nothing extra. That's the point there. No extra fees.
Okay, so we wanted to show everybody. Everyone's talking about, hey, recessions, home prices, what's gonna happen, because there is a lot of recession talk. We've been talking about this. I want to go through this slide pretty quick, but we're going to reiterate this, let everybody know that in the past 48 years, we've seen seven recessions. In one of those, did we see those home prices really decrease.
And it was the actual housing market that caused that recession.
That's right.
So that's the unique thing about that.
Yep, that's right. And you can see the column here, and these columns in gray. These are the recessions. Of course, a lot of us lived through, we were working, we were trying to make a living during this time, and we felt it severely. And it was the homes themselves, the real estate that brought it down. Now, some could argue, well, the home prices went down in 1992, maybe a little bit, maybe in the tech boom. Yeah, yes, you could probably make the case in some local areas it did, but overall,
but it wasn't significant, and it wasn't very long.
Yeah, overall, 6 out of the 7 recessions, home prices were stable or went up. All right, and we really have a lot of evidence to believe that today, if we are in a recession, which will be reported maybe this summer, perhaps, we will not see home prices decrease.
Mm-hmm.
We will be like the other. Again, this is not like the setup in 2008.
And also remember, markets, economies have to go through some resets. That's just the way it is. Life is a reset. You're constantly resetting. So don't let the R word, recession, scare you in any way. It is just part of life.
Yeah, that's right. And I think this is a really good slide to show everybody. You ever wonder, how much money do I have to make to qualify for a mortgage? Well, I'm going to try to simplify this. We're going to show people if they have $100 of monthly debt, $500 of monthly debt, $1,500 and $2,500.
And this is not including mortgage debt, right? This is just
right.
Non-mortgage debt.
Yeah, that's correct.
So forget your rent, forget your mortgage payment. This is cars, boats, RVs, student loans.
Oh, that's right. And forget your rent too. So if you're renting, don't count that. This is non-mortgage or non-housing debt. All right. So if you based off of this monthly debt, if you're buying a house that's $490,000, which happens to be in Maricopa County where we're at, that's about the median home price, $490,000. If you're putting 25% down, now all of these numbers are technically the same, except right here,
look at that.
Income
That's
to qualify.
income.
If you only have $100 of monthly non-mortgage debt.
So basically, if you're debt free, you need to make about $65,000.
Yeah, which is our median income in Maricopa County. Okay. Median income can afford the median home price.
Okay, good. And then the next one is if you have maybe a couple credit cards or a small, car payment with the credit card,
$500 a month.
Yeah, your income's got to be about $75,000.
Yep, and you'll see your payments up here, guys. Yep. But okay, and then $1,500.
Yeah, $1,500. So what is that? That's maybe a Tesla payment. That's maybe a couple of decent credit cards.
Yeah. Or a bunch of student loans.
Or just a bunch of student loans.
Yeah.
That's right. Look at the income, $100,000.
And if you have $2,500 of monthly debt, that's double. I mean, you had to make $62,000 if you had $100 of debt, but if you had $2,500, you have to make double.
Mm-hmm. Which is interesting. Look at that. You only have to make double the income to be able to afford, what, 2,000% higher? What is it?
Yeah. Well,
in debt. You go from $100 a month to $2,500.
Yeah.
Like, holy cow, that's huge. But you only have to make double. Anyway.
All right. So again, this is how important debt is, to keep it low, how much it actually helps to increase your purchasing power.
And if you see yourself incurring debt, buy the home first, then incur debt later. Don't do the opposite.
So remember, we do this Monday through Friday, the interest rate update. Be sure to subscribe, like, comment, and we'll be back tomorrow.
Hey, thanks, folks.
Thank you, everyone, for watching our show today. If you have questions, be sure to email us at rates@azmortgagebrothers.com, and be sure to take a look at all of our other videos on our channel.